Hello everyone, greetings of the day. So today we are here to address one of the question that relates to the stock market. So when you are investing in an entity, whether to decide your investment decision solely on the basis of PE ratio is justifiable. So PE means what the price of that stock is in comparison to its EPS. So the PE ratio means market price of the share divided with EPS. So this you must be aware. So let's suppose if a stock is trading at rupee 200 and it yield a return of rupee 10 on a year basis, then its PE ratio would be 20. Okay, so 200 divided by 10 will give you the result 20. So its PE ratio is 20. So if this multiple is on a higher side, this means that for a lower earning you are paying a much higher price. That is not justifiable. So in case we reverse this, then we can get a reliable measure to decide whether we should invest in this entity or not. So if we compare earnings to price, let's suppose if we compare rupee 10 divided with rupee 200, then we will get 5% return. 10 divided with 20 into 100 will give me 5% return on a year basis. So then I will see that this return that the entity is given to me is much lesser than what FD yields. So I will base my investment decision and will not invest in this entity. So if the PE multiple is on a higher side, then its earnings to price ratio would be on a lower side. So you are paying much more than what entity earns. It will give you only a 5% return. So it's not important that you look at PE ratio, but it's important that you look at earnings to price ratio, because that is the return that you are actually earning. Hopefully this video would have clarified and you would no longer run besides only the PE ratio of the entity. It's basically the earning that an entity earns when you invest in that at that price. So that is more important, that is of more importance to an investor.